It has started. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the unthinkable has started as the U.S. economy is now at its breaking point. And wait till you see what's happened, because you're about to find out just how close we are to the edge. And this comes at a time when political elites remain in complete denial. Plus, the next big gold rush is in AI, which is why we're excited about our sponsor for today's show, Genesis AI. You may have noticed that many of the companies we feature on this show recently have seen their stock prices go up, and that is because we vet them for opportunities for growth that we think that you can take advantage of. And with Genesis AI, we're looking at a potential of a 50% return. Stay tuned or check out the pinned comment or description for more information. Now let's head on to Bloomberg, where we pick up today's story with Houthis menacing fleet shipping great detour around Africa gathers pace. Now, in yesterday's show, we talked about how the potential that if we do not see goods from international trade flowing to the U.S., that perhaps it could lead to inflation. But nevertheless, what we expected and what we're not surprised to see is the U.S. step in. And just hours before Metre's announcement, the U.S. Defense Secretary Lloyd Austin announced the creation of a task force to protect commercial vessels traveling through the area. The shipping giant's decision shows it's not banking on that bringing an immediate halt to attacks. While the details are still being worked out, it's not clear when it will start to work. And this is an important piece here, because when we talk about the global economy, global trade is absolutely critical. Of course, the shipping industry is massive. And in order to keep the wheels of the U.S. economy greased, we need to see a constant supply of goods from the east moving to the west, and at all costs. And this is important to understand that we will take advantage of making sure that this continues, because any disruption in global trade would have just massive consequences to the U.S. economy. And of course, this is happening at a time when investors could not be more excited about the opportunities in the U.S. equity market. In fact, they're so excited, they're buying at all-time highs. And if you're wondering what we're doing at Bank of America today, well, a recent survey says they just can't get enough. As B of A poll shows, rate cut expectations are fueling a rush into equities. And something we note is that this tends to happen at every cycle peak. Just as the Fed's cutting rates, investors actually start to believe the narrative that whatever the Fed is pushing at the time, with this time being the mythical soft landing, that they are absolutely going to be able to engineer a decline in inflation without breaking the labor market. And what that tells investors is it's time to pile into stocks. And many of you have said, Steve, I don't understand why people are buying stocks as the global economy is slowing. Well, now you're about to find out why. The sentiment of global fund managers surveyed in December was the most upbeat since January 2022 on a Goldilocks environment, a steady economy that's not running too hot or too cold, as a case for next year, as a team of strategists led by Michael Hartnett wrote in a Tuesday note. And this is what's interesting, because we're going to look at why the U.S. economy is literally on an edge, on the tipping point, because we just got some data in November, which really changes everything. And it really shows that this has started our downward spiral. And yet, meanwhile, as you're seeing, investors are just piling into stocks. And against that backdrop, the poll showed investors are the most overweight on stocks before the Fed started to hike interest rates, with cash allocations cut to a two-year low of 4.5% from 4.7%. And this is really interesting, because most people, and I see in the comments, you say, look, Steve, I'm waiting for an opportunity, let the thing come down. And yet what actually happens is most investors buy the most at the top. You're seeing that happen now, and it's all on the belief that the Fed pulls this off. But as you're going to see, the odds of that happening, well, they're about zero. Meanwhile, fund managers are the most overweight on bonds in 15 years, taking the opposite side of the trade. They're also the most bearish on commodities relative to bonds since March of 2009, which would make absolute sense, because commodities tend to do poorly during a global recession. But let's take a look at why investors are so hopeful, and yet they do this every time. We're looking at the Wilshire 5000 price index in blue against the federal funds effective rate, and here we can see that being in red, and you'll notice that the market will peak, come down, and it will take up another leg higher. As what's happening, the Fed is either signaling a cut or starting to cut, and what investors then find out is the Fed's cutting because perhaps things are much worse than they thought, and that brings the equity market down. You see that happen again going to the global financial crisis. Again, markets making a new all-time high as the Fed starts to cut, only to find out that they're in the wrong place at the wrong time. And going again into the pandemic, investors made the mistake again, only to get crushed. But thanks to all the pandemic stimulus, they bought like crazy and now are looking to make the same repeated mistake as they do before every recession, and that is cram into equities. In terms of risk, investors are most wary of a hard landing, and we're going to make the case here in a little bit of why that is the likely case, or a recession in 2024. That said, and that 66% or 2/3 are anticipating a soft landing for the global economy over the next 12 months. So this is really the case of buy the dip because it's going to be great. I know many of you probably disagree with that, but I want you to see what the polls say and then wait till we see what the data suggests. As Hartnett said, the best hard landing contrarian trade is long cash and short the group of stocks he calls the Magnificent Seven, such as Apple, which is something nobody really wants to short. And their evidence is strong that indeed the equity market is going to come down because in order to keep markets running, you need people to buy at higher and higher prices. And in order to do that, you need more and more money created in the economy. And this is why we come back to the banking system. Again, another reason we're at B of A, not only they put out the research, but of course they're a major commercial bank. And here we can see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. That's shown in blue, with the banks tightening anytime you see that blue line over that horizontal black line, that against the Wilshire 5000 price index or total U.S. stock market. And sure enough, as banks tighten lending standards, well, you just don't have enough money to continue to fuel equity prices. And next thing you know, the economy starts to slow down, and in some cases contract, and there goes the equity market. You see that every time. Now, the reason I put a question mark here is because this time investors believe we are at the bottom of the next great bull market. They believe the bear market's already over. And yet, as we can look at the interest rate market, we know that going forward, banks are going to continue to tighten lending standards until the economy breaks. Of course, this is all driven by the political elite. But yet, nevertheless, there are still opportunities even in a down market, because the next big bull market is going to be in AI. This piece here from Motley Fool, they say history has a way of repeating itself, and over 170 years ago, a gritty visionary by the name of Samuel Brandon made a fortune as one of the earliest investors in the California gold rush, not by digging for gold, by selling the tools miners needed. And of course, what can we learn from this? Because while the days of panning are over, the days of fortune hunting are not. And this is the AI gold rush, as you'll see later in today's show, is sweeping the globe. And we think our sponsor, Genesis AI, is going to be one of those companies that literally is going to be putting out fires, as you're going to see. And here we can note, quote, the world's first trillionaires are going to come from somebody who masters AI, as machine intelligence is the last invention that humanity will ever need. And savvy investors are going to get in early and get rich. But before we get to that, let's talk about what's going on in our lead story, as Tough Times' new 2023 rent delinquency record reached 41% couldn't pay in November. Now, we talk about, again, the U.S. economy being on the tipping point. We'll talk about the opportunity in AI here in a little bit, but I want you to understand the U.S. economy is not a reflection of the U.S. equity market. So many people look at the stock market and say, well, the economy must be doing good. In fact, as I showed you, there's not much of a relationship near the peaks as you've seen. And here we can look at this report. Despite some stabilizing economic trends reported by the federal government, the financial picture for many small businesses is far from rosy, as they've confronted with increasing challenges around revenue generation, managing still high interest rates, cumulative inflation, and rent spikes. And something we've talked about during the retail sales report is how, adjusted for inflation, retail sales are actually still negative. And I made the case that retailers need to see this number be positive, that despite the headline government data, the unadjusted data saying, look, we're actually seeing an increase in retail sales. It's not enough for small businesses. Sure enough, the evidence is here. In fact, Alignable's November rent report released today shows that rent delinquency rate among small business owners across the U.S. has reached a new 2023 high as 41%. That is a staggering number. Could not afford to pay their rent in full or on time this month. This follows 2 consecutive months of a 40% rate in October and September, validating that small businesses are indeed struggling here. And we talk about the U.S. economy being at a breaking point because if we're going to experience a soft landing, as 66% or 2/3 of all investors believe, then why are 41% of small business owners unable to pay their rent in full or on time? Things are not adding up. Investors are looking at prices of stocks going higher and failing to see that the economy underneath is outright crumbling. But evidence shows that delinquencies are likely to head a lot higher. As again, we come back to the chart we started with, the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. That in blue against the delinquency rate of all loans at all commercial banks. And notably, what do you see as banks tighten lending standards? Well, delinquency rates go up. And during the global financial crisis, well, they went up a lot as we experienced an all-out financial crisis. This time we haven't seen it show up in the data yet, but I imagine in the near-term future, we're going to see delinquency rates start to spike a whole lot higher, showing indeed the economy is at a breaking point. And that's because the small businesses can't pay a basic cost like the rent. Well, what else are they unable to afford? These concerns naturally lead to worries about how long these entrepreneurs will be able to stay in business. But is it about them? No, it's not just about them. They are indeed critical to the economy, but it's also about their employees. Because if you can't afford to pay your rent, then how can you afford to keep paying your employees? And sure enough, we look at that relationship, and what do we see? Continued unemployment claims in blue against the delinquency rate in red for all banks and all commercial banks. And notably, what do you expect to see? It's just exactly what this chart tells us, that as more people are on unemployment and unable to find work and are still on unemployment, well, the delinquency rate goes up. And you can see it here happening in the 1990s, happened again in the dot-com bubble. It happened going into the global financial crisis. And here we're seeing it now, which is surprising because you'd think the political elites would be panicking. Instead, maybe they're actually under the belief that they've got this thing right. But it gets even worse. A shocking 40% of student loan borrowers missed their first payment after the pandemic era freeze expired. Now, of course, all of these borrowers were given well in advance notice that this was coming, and yet still, what is this a sign of? It's not a sign of a soft landing. It is a sign that the U.S. economy and the global economy is running out of money because central bankers have inverted yield curves and inverted money curves and constricted the creation of credit, meaning there just isn't enough money to pay on all the debts. In October, the number of Americans delinquent on subprime auto loans hit the highest on record amid a rise in Google searches for, quote, give car back, while the number of people who are upside down on auto loans is at the highest level since April of 2020. Now, according to data released Friday by the Biden administration, 40% of student loan borrowers skipped their payment in October, the first since the pandemic-era freeze on student loan debt expired. Around 8.8 million, that's a huge number, out of 22 million borrowers who missed their October payment failed to make their payment by mid-November, a sharp contrast to October 2019. Think back to pre-pandemic period when 26% borrowers missed their payments. Now, this is staggering. While most borrowers have already made their first payment, others will still need more time. Some of them are confused or overwhelmed about their payment options. We want to make sure borrowers know that our top priority is to support student loan borrowers as a return to repayment. The reality isn't that they don't know how to make the payment, they don't have the money to, which is interesting because we talk about what has been boosting retail sales, but we'll take a look at that in a moment because what we see right now is a huge opportunity in AI stocks, and one company we think is going to be putting out fires in a big way in this space is Genesis AI. They're a future unburned, a forest fire management reimagined with AI is empowering North America's forests with advanced AI solutions to detect, prevent, and mitigate devastating fires, ensuring a sustainable and resilient future. And you can find Genesis AI on the OTCQB under the symbol AIGFF or on the CSC under the symbol AIG. All the information in the pinned comment and description below. Let's take a further look at what this company is doing and why we think their stock could go up as much as 50%. Because they're revolutioning forest fire management with AI, as they've got the technology to handle all these record-breaking fires. They've got AI for early detection to handle rapid response to forest fires, playing a crucial role in saving lives and reducing greenhouse gas emissions. They've got digital twin technology and massive global impact with applications spanning indigenous land management, agriculture, disaster management, and carbon offsetting. Their technology contributes to global efforts in mitigating and managing climate change and conserving natural resources. And this is one of the reasons we think their stock is about to take off. Let's take a look at their chart here. And here what you can see, we've got the supply zones drawn in here in those purple bars. Looking at the 90-day chart, we see the buyers down here below, right around 8 cents, making Genesis AI a tremendous opportunity. And what do we see? Prices come rallying up out of the supply zone. And then on a pullback, found support, and then a little bit of rally and a pullback. And look at this huge volume here as buyers came in. And notably, you can look at the volume profile line. You see underneath, this is where buyer support is at. We see an upward move here from 14 cents all the way up to 21, taking a potential 50% return in Genesis AI. Again, on the OTC QB under AIGFF and on the CSC under AIG. Now let's look at how bad the position is for U.S. consumers and why indeed we're at the breaking point. It has more to do than just small businesses missing payments. It has to do with the fact that consumers are just tapped out of cash and can't make their student loan payments, but it's how they're financing the holidays that leaves us all wondering. Buy now, pay later keeps people spending without credit agencies knowing. And due to the massive money shortage, consumers are flocking to installment loans from everything from groceries to even laser eye surgery. As consumers are shifting more of their spending to so-called buy now, pay later lenders, a trend that is only accelerating as high interest rates dent budgets and pandemic savings dry up. That sounds alarming as consumer advocacy groups say companies like Afterpay and Affirm and Klarna provide fewer protections in credit cards and encourage shoppers to take on more debt than they can afford. And the issue here is consumers can't afford what they're buying now, so they believe in the soft landing narrative that they're going to be able to make the payments early in the next year. Of course, the case we're making is the U.S. economy is going to continue to slow, and money that is being spent today on consumption is not going to be spent on consumption in the early next year. It's going to go into debt service, which is a massive problem. A quarter of all American adult consumers now have used the buy now, pay later loans, according to LexisNexis Risk Solutions. Over Black Friday and Cyber Week, such payment plans accounted for a whopping 7.2% of all online sales, a 25% jump from last year. They were also a big factor in the declining use of store credit cards. Meanwhile, the political elites remain confused because what we see here is all of this massive evidence that the U.S. economy is indeed at a breaking point because consumers are now doing the unthinkable. They're missing payments. Small businesses can't pay their rents. And what are we seeing? Financing of consumption out now in the next year. It's a perfect storm. And you would expect these political elites would be seeing this, and yet they remain confused. As Fed's Goolby says he was confused By last week's market reaction, the market expectation number of rate cuts is greater than what the SEB projection, he said, is. And that's because, Goolsby, the market doesn't care what your projections are. They've figured out long ago that when you start talking about cutting, that you haven't figured out that you don't stop. And that's why we look back in the charts. There's very few times the Fed has cut before it's actually brought rates back up. Most of the time, when the Fed starts cutting, it's game over. You were at zero once, you were at zero twice, you're going to be back at zero again. And the only thing you're going to be confused by is how you're going to get the federal funds rate negative. As Fed official says, rate cuts could be needed next year to prevent over-tightening. Well, it's too late. As Daly said, she's watching the effect that restrictive policy has on the labor market. And when the unemployment rate starts to rise, it tends to go up a lot. And not only by a little bit, she says. As a result, we have to be forward-looking and make sure we don't give people price stability, but take away jobs. And that's the case we make with small business owners. If they're not going to be able to pay the rent, they're certainly not going to be able to pay their employees a whole lot longer. And Daly said she thought interest rate policy was in a good place to achieve that result. But in a notable shift, she said the Fed's new focus needed to turn toward paying attention to both sides of its mandate. And here we can see, looking at the federal funds rate, this is what the market's pricing in, Goolsby, is that it's too late. The continued claims, when they go up, you should be cutting rates. In fact, historically, the Fed is cutting rates as continued claims start to rise, and notably, that doesn't have any effect on it. This time, continued claims are going up, and your game is to hold rates. And you're not the only ones, as the ECB's Stimka says the market's rate cut bets are too optimistic. And I want you to see that these political elites are indeed bent on crashing the global economy, whether they realize it or not, whether this is a conscious effort. I don't agree. I just remain that they are completely clueless of how the system works. I think market expectations are too optimistic, he told reporters. We have to see further surprises, and if there are no surprises, then the expectations of early and fast interest rates cuts may be too optimistic. Well, I got news for you. You're going to get a lot of surprises as the global economy continues to crumble down. In fact, even Japan, who has been talking about getting out of negative interest rate territory, couldn't do it. As the yen plunges after the Bank of Japan admits it's too difficult to exit negative rates, shattering normalization hopes, putting a tailwind behind the bond market and validating that indeed we are on the edge of a breaking point. U.S. consumers now, as we see in the data, completely tapped out. As always, with anybody we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.